You're listening to Indications by the Conference Board.
Welcome to Indications. 2019 was a bit of a roller coaster for consumer confidence. The year started down around 120 on our consumer confidence index, thanks to a government shutdown. By the summer, the index had rebounded and it was peaking at above 135, which was nearly an all-time high. Confidence moderated in the fall on a range of global uncertainties and finally closed in December at 128.7, up around 7 points for the year. I'm joined with Lynn Franco, who runs our Consumer Confidence Index and is our senior director of economic indicators. Lynn, what happened in January 2020 when we returned from the new year?
Well, Jonathan, I think some of the uncertainty that you just mentioned has dissipated with a trade deal. So that probably added a layer of comfort to consumers. And also, I think more importantly is that, these high confidence levels that we've been seeing and the reason why consumers have sort of managed to survive the roller coaster ride is due to the job market. It remains very strong. Expectations are that we're going to have solid growth in 2020, and we all know that jobs are very key to consumer confidence. So I think this is going to continue to at least support strong confidence levels for the first half of 2020.
And in our January survey, we saw improvements both in the overall index, we're back above 130, and then also improvements to both the present situation and the expectation index. Is that right?
Yes, and for the present situation index, it's at 175.3, extremely high levels. So it tells us that, the consumers are telling us that, economic conditions remain quite solid. They were positive about business conditions. They were even more so about job conditions. So again, the employment continues to be a key factor here.
And the continued resilience of consumer confidence now a decade into the expansion does seem to contrast a little bit with what some business leaders have been telling us. The Conference Board's annual survey of C-suites actually found that recession risk was one of their top concerns for 2020. Lynn, is this a disconnect mean one side, either businesses or consumers have it right and one side will ultimately be proven wrong? Or does it just more demonstrate that consumers are really the driving force behind economic growth in the present economy?
Well, I think, consumers and CEOs are facing sort of two sides of the same coin. If we take a look at sort of our CEO confidence measure we had seen back in the third quarter of 2019, it hit a decade low, and a lot of that was due to the sort of trade dispute that had really heated up. And we even did a separate poll of CEOs, and we found that, that was impacting their businesses and their business decisions. And that tended to make them cautious and sort of put business investment on the back burner. We did see a rebound in CEO confidence in the fourth quarter, but they still remain a little bit sort of pessimistic. On the flip side, we have seen where that same, trade rhetoric or trade dispute have an impact on confidence much more short term. It might be for a month and then we tend to rebound. And part of that is because the prices are not sort of getting passed through to consumers. So the impact has been minimized, at least on consumers, where I think CEOs are being impacted more so, and they have longer term decisions to make. So we've sort of seen this disconnect. We expect probably now that, the trade dispute is really we've gotten a trade agreement, that some of this will ease over time, and we'll see CEOs gradually becoming a bit more confident as the year progresses.
So is it fair to say with the phase one of the U.S.-China deal now in place that consumers have that the coast is clear for consumers, that they've kind of escaped the brunt of it without having those costs passed through, or are there still risks ahead?
There could always be risks ahead, but at least the price risk seems to have dissipated somewhat. So I don't think, a trade dispute is high on the list of consumer concerns at this point. So I think for at least consumers, the worst is now behind us.
Well, so that sets the stage for, I guess, my next bit of questions. 2020 is, of course, an election year, and we're speaking a week before the first voters get a chance to caucus in Iowa. Generally speaking, and taking from past experience, what has consumer confidence been able to tell us will happen in November from this far out? Is the really high levels that we're seeing in our January report obviously good news for President Trump, or is it a little bit more complicated than that?
Well, it all depends which scorecard we take a look at here. So we have something called the midterm scorecard. So there, if you take a look at, where confidence is at the midterm, if the expectations...
So that would, in this case, it would be 2018?
2018, okay. Yes, 2018. If expectations exceeded the present situation, then that always bodes well for the party in office. Looking back, consumer confidence was at 136.4. The present situation in 2018 was at 172.7. Expectations were at 112.3, gives us a minus 60.4 reading. So that did not necessarily bode well for President Trump. Now, fast forward to the pre-election scorecard, which, if you take the September reading before the election, and if confidence is well above 100, that bodes well for the party in office. So, we're not quite there at September, but right now we're in the 130s. So according to this scorecard, that would say that President Trump is likely to be reelected. So I guess it all depends on which scorecard we look at.
Do you have do we have any data on just going the decades into the past as to which one of these measures is more accurate or gets it right more often, I guess?
The midterm scorecard, I think, has been a little bit more accurate. We'll put a footnote on the sort of pre-election scorecard and saying that it's had a good record at predicting the popular vote. But as we all know, sometimes you can sort of win the popular vote, but not necessarily be elected. And we've had a few instances throughout the history where that's been the case.
That's fascinating. So let's dive. I mean, kind of on the election story again. It looks like, as we were saying earlier, that the trade conflicts that had kind of been that had been in the background for the past 3 years now, and they seem to have been pretty much resolved, at least for the time being. Are there, as you look ahead, are there clear risks to consumer confidence from some of the stories that are emerging to take its place? I'm thinking of the coronavirus outbreak in China, or possibility of renewed conflict with Iran. Are there any forces out there that you can see around the corner and feel like would impact confidence this year?
Well, I think, depending on what happens with the coronavirus, we're sort of still in very early stages. The same with the situation in Iran. It could have temporary impacts on consumer confidence. We've seen this with other types of shocks, whether it's a financial shock or an economic shock or a weather-related event. It can have a temporary impact on consumer confidence. The question then becomes, do we rebound or do we not rebound? And that all depends on what happens with the economy and, in particular, the labor market. So past shocks we've seen where confidence has taken a hit, but tends to rebound within a month to 4 months. So unless there's sort of severe economic consequences, these types of events are short-lived.
It's interesting. So, I mean, obviously the top line numbers in January 2020 are really quite strong. But we are seeing, some divergences and some interesting trends in our breakdown by region and by demography. Last year, or at the very end of last year, so in December, commentators noted that in the consumer confidence index there was a historically large generation gap that had grown up or opened up between the confidence of those over 55 who were very confident and more pessimistic millennials and Gen Zers coming up after them under 35. There are actually two fascinating pieces, I think one in Axios and one in The Atlantic, that refer to this phenomenon, and we'll link to them in the show notes. And they kind of get into when they see this as evidence of political significance for the election this year. The gap has closed somewhat in January, but historically the situation has been reversed where people under 35 generally had higher confidence than people over 55. So I mean, Lynn, do you feel like this is this just noise, or do we think that there's a real trend here?
Well, I think we have to wait and see if it's just noise or a trend. But I've seen other articles as well that have sort of mentioned that the millennials now will be the first generation to not exceed their parents' standard of living. So I think, it's interesting to see if this is going to play out in the confidence figures as well, and if sort of this disparity that we see between a younger generation and an older generation is going to continue over time.
And what about the regional breakdown? Are we seeing any parts of the country that are especially confident, and any ones that are especially worrisome?
Well, I think we've got, certain pockets of the country that are more optimistic than others. Take a look at New England, confidence is at 136.6, or take a look at the South Atlantic states, where we're above 140, and compare that to the Middle Atlantic, where we're just at 115.3. But I think the real takeaway here is, yes, the level does matter, but so does the trend. So there's no particular region of the country where we're suddenly seeing a significant weakening or a persistent weakening that would lead us to believe that perhaps something else was underway. So while they're all sort of varying degrees of confidence, I think overall the trend still remains quite positive throughout.
So while there doesn't seem to be much, there doesn't seem to be any clear signs in the geographic data, there are some trends, I think, in the breakdown by household income level. Is that right, Lynn?
Yes. And I think what we've been seeing here is sort of this, a tale of two consumers, so to speak, where those earning under 50,000 have been much less confident, and it's taken them much longer to sort of rebound to pre-Great Recession levels. And confidence is much stronger amongst those earning 50,000 and over, and especially amongst those earning 125,000 and over. And a lot of that has been sort of fueled by what's been happening in the financial markets, and what's been happening in sort of the housing market as well. But I think what's interesting is if we take a look at sort of the last couple of months, confidence levels have improved. Again, they fluctuated, but they have improved amongst the 50,000 and under. And I think some of that can also be tied into the tightness that we're seeing in the labor market, and the wage increases, which have really been more so concentrated amongst blue-collar workers. So I think that's sort of helped get the confidence levels back up to above 100 for those earning under 50,000 or more.
So the income gap, the confidence gap by income was larger, but it seems like it could, the gap could be closing as we start 2020.
Yeah, it seems to have closed a little bit, and now we've got sort of readings, above 100, above 90, as opposed to, in the 80s. So I think we've seen a little bit of strengthening there, and we know confidence is driven by what's happening in the labor market, and other work that we've done here as well just shows that, the biggest wage gains, and the biggest tightness has been amongst blue-collar workers.
Interesting. So we're going to check back in on consumer confidence throughout the year on indications. But before we sign off, Lynn, anything else you want to add just for our listeners to watch out for?
I would just keep an eye on what's happening in the labor market. That's really the key to consumer confidence. So if we begin to see any sort of significant change in terms of, more layoff announcements, that could have a negative impact on consumers and in turn could have a negative impact on spending.
Great. Thanks, Lynn.
You're welcome.
This has been Indications from the Conference Board.